Hey there, welcome back to our channel. Today we're going to be talking about passive investing, a term that's been gaining a lot of attention lately in the world of finance. So what is passive investing, and how does it differ from other investment strategies? Let's dive in and find out. First, let's define what we mean by passive. When we use the term passive in the context of investing, we are referring to a style of investing that involves buying and holding a diversified portfolio of assets, and not actively trading or trying to time the market. In other words, passive investors do not try to beat the market by making frequent trades or trying to pick individual stocks. Instead, they take a more hands-off approach and let their investments grow over time through the power of compound interest. Passive investing is often contrasted with active investing, which involves actively buying and selling stocks or other assets in an attempt to outperform the market. Active investors often rely on market research, financial analysis, and other strategies to try to identify undervalued stocks or other investments that have the potential to outperform the market. While active investing can be lucrative in some cases, it also involves a higher degree of risk and requires a lot of time and expertise to be successful. On the other hand, passive investing is a more straightforward and low-risk approach that is accessible to a wider range of investors. One of the key advantages of passive investing is its simplicity. Rather than spending a lot of time researching individual stocks or other assets, passive investors simply invest in a diversified portfolio of assets that tracks the performance of a particular market index. For example, they might invest in a low-cost index fund that tracks the performance of the S&P 500, which is a broad index of 500 large-cap U.S. stocks. By investing in an index fund, passive investors can achieve broad market exposure with minimal effort and expertise. Another advantage of passive investing is its low cost. Since passive investors are not relying on a team of experts to pick and choose individual investments for them, they typically pay lower fees than active investors. In fact, some passive investments, like index funds, can have expense ratios as low as 0.05%, which is significantly lower than the fees charged by many actively managed funds. So how does passive investing work in practice? Well, there are a few key principles to keep in mind. Passive investing is a style of investing that aims to achieve long-term growth by buying and holding a diversified portfolio of assets, such as stocks, bonds, and other securities. The key principle behind passive investing is to track the performance of the broader market, rather than trying to outperform it through active trading or market timing. One of the most popular ways to implement passive investing is by investing in index funds or exchange-traded funds. These funds are designed to track the performance of a particular market index, such as the S&P 500 or the Russell 2000. By investing in an index fund, investors gain exposure to a diversified portfolio of stocks or other securities, which can help to reduce risk and maximize returns over the long term. Another key principle of passive investing is diversification. By investing in a variety of different assets, investors can help to spread their risk and avoid the negative impact of any one asset on their overall portfolio. For example, investing in a mix of stocks and bonds can help to balance out the risk and return profile of a portfolio and reduce the impact of market volatility on overall returns. Low costs are also a hallmark of passive investing. Unlike actively managed funds, which require a team of professionals to actively trade and manage the portfolio, index funds and ETFs are designed to track the performance of a particular index and therefore have lower management fees and expense ratios. This can help to reduce costs for investors and maximize returns over the long term. Another key principle of passive investing is a long-term mindset. Rather than trying to time the market or make short-term trades, passive investors focus on building wealth over the long term through the power of compound interest. By staying invested and avoiding the temptation to make emotional decisions based on market fluctuations, passive investors can reap the rewards of long-term growth and maximize their returns over time. Finally, it's worth noting that passive investing is not a one-size-fits-all strategy. While it may be a good fit for many investors, it's important to consider your individual financial goals, risk tolerance, and investment timeline before deciding on a particular investment strategy. Working with a financial advisor can be helpful in determining whether passive investing is the right fit for you and developing a customized investment plan that aligns with your individual needs and goals. So why should you consider passive investing? Well, there are several reasons why you might consider passive investing as a strategy for building wealth over the long term. First, passive investing is a simple and straightforward approach to investing. Instead of trying to pick individual stocks or time the market, you simply invest in a diversified portfolio of assets, like stocks and bonds, and hold onto those investments for the long term. This takes a lot of the guesswork and complexity out of investing, and can be a great option for those who are new to investing or who don't have the time or expertise to actively manage their investments. Second, passive investing is typically much cheaper than other investment strategies. When you invest in actively managed funds or individual stocks, you often have to pay higher fees and expenses to cover the costs of the professionals who are managing your investments. With passive investing, on the other hand, you're simply buying a low-cost index fund that tracks the performance of the broader market. This can save you a lot of money in fees over the long term, which can have a big impact on your overall returns. Third, passive investing is a proven way to build wealth over the long term. While it's true that passive investors won't beat the market, they also won't significantly underperform it, like many actively managed funds do. In fact, research has shown that passive investing can often outperform more complex strategies over the long term, thanks to the power of compound interest. By staying invested and avoiding emotional decisions, you can reap the rewards of compound interest and let your money grow over time. Finally, passive investing is a low-stress way to invest. Because you're not trying to time the market or pick individual stocks, you can avoid a lot of the stress and anxiety that can come with more active or complex investing strategies. This can help you stay disciplined and focused on your long-term goals, rather than getting caught up in short-term market fluctuations or trying to chase after the latest hot stock. Of course, passive investing isn't for everyone. If you're looking for a more active or hands-on approach to investing, or if you have a high tolerance for risk, then other strategies might be a better fit. But for many investors, passive investing offers a simple, low-cost, and effective way to build wealth over the long term. If you're interested in learning more about passive investing, be sure to do your research and consult with a financial advisor to determine if this strategy is right for you. In conclusion, passive investing is a strategy that involves buying and holding a diversified portfolio of assets, and letting your investments grow over time through the power of compound interest. It's a simple, low-cost, and low-risk way to build wealth over the long term, and it's backed by decades of research and evidence. While it might not be as exciting or glamorous as other investment strategies, it can be a powerful tool for anyone who wants to build a strong financial future without taking on too much risk or complexity. Of course, like any investment strategy, it's important to do your research, consult with a financial advisor, and make sure that it's the right fit for your personal goals and circumstances. But if you're looking for a reliable and proven way to grow your wealth over the long term, then passive investing is definitely worth considering. So why not start today and let the power of compound interest work its magic for you? So there you have it, a brief overview of passive investing and how it works. If you're interested in learning more, be sure to do your research and consult with a financial advisor to determine if this strategy is right for you. Thanks for tuning in, and we'll see you next time.